Hi, welcome back. This is Paul Chan from DLBS. Let's begin our next video together. Welcome everyone to our 10th video. It's been quite a journey so far. I congratulate everybody who completed the first 9 videos. It's been quite a journey and learning experience. I hope you enjoyed all the videos we put together for you. So let's get started. Today we will talk about calendar spreads. Here's the agenda we have planned out for you. We do a quick recap of the simpler one-leg strategies that we talked about in videos 4, 5, 6, 7. And then another quick recap of the two-leg spreads that we talked about in videos 8 and 9. Then we are introducing to you a new concept called calendar spreads, and there will be 2 types, both horizontal and diagonal. And we have selected 2 stock examples for you today. One is Sandstorm Gold for the horizontal calendar spread, and another one is Barrick Gold for the diagonal spread. At the end, we'll summarize with all the free tools that we show you, as well as how to get your free copy of Options Play subscription for Canadian equities, as well as 1-month trials for American equities. So let's get started. So based on everything that you have learned so far, you probably can figure out by now when the share price is forecasted to rise, you have several options at your disposal. Simpler one would be a one-leg option strategy, such as buying a call option. We talked about that in video 4. You could also use selling a put option, a naked put type strategy to collect money up front. We talked about that in detail in video 7. And the reason why we have these in red is where you're spending money, but it's really an investment because you're expecting that call option value to increase over time, of which then you will close out your position and take the profit before expiration. On the other hand, with selling an option, you're collecting money up front on day 1, and that's why you see the lock symbol next to the dollar sign. It is locked. Your income is fixed. You cannot gain any more than the premium you've collected up front. So it's an income strategy. After watching the last 2 videos, you're now a little bit more comfortable with 2-leg option strategies, where you have bull call spreads in video 8 that shows you how to invest money, as well as bull put spreads and how to collect money. And again, when you have bull call spreads, you're hoping the spread will increase in value over time as the share prices rise, whereas the bull put spread collects money up front as an income generator by way of a credit spread. On the other hand, if you forecast a particular stock to fall, now you have at your disposal tools such as buying a put option, as discussed in video 6, selling a call option, as discussed in video 5. And again, buying a put option, you are expecting the value of the put that you purchased to increase in value as the share price falls. On the other hand, if you were to sell a call option, it's a wonderful way to protect yourself in a bear market because you are collecting money up front by selling an insurance to somebody else. And then using 2-leg options that we talked about in video 9, you can use a bear put spread, where again you're investing money, or you are able to execute a bear call spread where you collect money up front. Anytime you're investing money, you are contemplating an increase in your spread value, so you can close it out later on for a profit. Or with a bear call spread, you're collecting money up front by way of a credit spread. And when we put all of these together, you will notice one thing that all the spreads we've talked about in the last 2 videos have in common. They all have a common expiration date. Whatever the expiration date you buy one for, you're selling on the same expiration date. Today we will introduce you to calendar spreads, and for the same reason why you have the word calendar, we are going to be executing trades where the buy and sells are on different expiration dates. So with a horizontal calendar spread, let's use this company XYZ as an example with a starting current price of $60 a share. My technical analysis suggests is in a short-term bearish to neutral position. There are no sudden price rises expected. But my fundamental and technical analysis suggests long-term bullish patterns. So I may buy a 6-month longer-term call option at a $60 at-the-money strike price for $5. And I will sell a shorter-term 3-month call for $60 as well and collect $3 in premium. $3 coming in, $5 going out. My net cost is $2, so it's a debit spread. And it's basically another form of a subsidized call option. Unlike the prior examples using the bull call spread, here my expirations don't match, so I am subsidizing instead of with a 6-month call option. I am actually subsidizing with a 3-month $60 strike price at the money. It's designed with less subsidy because of the short-term bearish nature of the stock. And this way it allows me to capture more gain in the 4th, 5th, and 6th months, which is when I expect the prices to rise even more. Here are 3 scenarios that may play out. First one is hopefully in the 3rd month, the share price remains below $60. So therefore my 3-month call option that I sold expires worthless. I keep the money that I collected from day 1. The investor still holds the 6-month call option. And as long as the longer term position remains profitable so that the time decay does not erode the 3-month premium that I collected, I'm in a good position. And hopefully the stock does break the way I expect it to, and it rises well above $60 after the 4th month. Now I'm capturing lots of gains. And if I can time this so that my RSI and on-balance volume peaks, I may be able to sell my $5 6-month call for, say, $9, pocket $4 in profit, and when I add it to my original $3 collected as premium for the call sold, I have a total profit of $7. The second scenario would not be as ideal. The stock did not rise as I anticipated. The share is flat. And as long as in the 3rd month the share price remains below the strike price of $60, I'm still in a good position. My 3-month call option expires worthless. I collect the money that I did from day 1. I still hold the 6-month option. Again, as long as the time decay does not erode the $3 I already collected, I'm in good position there. And if the share price still remains flat after 4th month, I can still sell the call option quickly, maybe time it when RSI and on-balance volume peaks. But this time is not as rosy as before. So let's say my $5 call option actually eroded in value down to $2.50. Well, if I spent $5 but I have $2.50 coming back at a loss, and I had $3 up front, I still come out of the trade with a 50 cents per share profit. The worst case scenario here doesn't look so good. It's a scenario where the stock never rose up as I forecasted. So after 3 months, my call option for 3 months, I still collect the premium up front. It expires worthless. I still have the 6-month option, but as I see the fall in price well below the $60, then I really need to get out as soon as possible. And if possible, time it when it's favorable for me from an RSI on balance volume indicator point of view. But let's say my $5 premium that I paid for the call option has eroded way down to 25 cents. Then I'm in a pretty bad position, but not quite as bad as losing $5 on a standard call purchase, because I still have 25 cents coming in at the time of sale, as well as the $3 that I collected from day 1. So I end up losing $1.75. The second type that we will teach you today is called the diagonal calendar spread. And if you look at the chart, again, XYZ is trading at $60, but this time my short-term technical analysis suggests it's a little bit bullish. It's not going to be flat or going down in the short term. The long term still looks rosy as well. So again, I will also buy the 6-month call option at the 60 strike price, $5. But this time I will not sell a call option at the same strike price. I will give myself a little bit more buffer. And I will sell a 65 strike price for less money, $1.50 in premium. So my net overall investment is $3.50, more than the prior example. Again, it's another form of a subsidized call option purchase, designed with less subsidy because of the short-term bullish outlook, and still allows me to capture more gain in the 4th month onwards. So let's look at the 3 scenarios again. The first one, share price going up. As long as it does not rise above $65 by the 3rd month, I still keep all the premium while I see the call option I sold expire worthless, which is great. I still have the 6-month call option. And as long as the time decay does not erode my $1.50 in premium, I'm still reasonably happy. And if the share price does rise above 60 after the 4th month, I'm capturing lots of delta. And I would probably want to time it so that when it's a next favorable position, when it's a high peak of RSI and OBV indicators, that's when I would sell and close out my position. So ideally, I may see the $5 call premium for 6 months rise to $9 in value by then. And so my total profit would have been $1.50 from the original 3-month contract sold, minus the $5 I paid for the 6 month, plus the $9 I will be collecting in, for a total of profit of $5.50. But if the scenario was the share price stayed flat, and as long as it did not rise above 65, I'm still keeping the premium from the call option sold, and it expires after 3 months, so I close out that position automatically. I still have the 6-month call, and as long as time decay does not erode that away, I'm in good position. And if the share price remains flat, then I would want to sell my call option sooner as opposed to wait. And let's say my call option has eroded in value from $5 to $2.50, then my original income from $1.50 minus the $5 I spent on the call purchase, plus the $2.50 I'm getting back in residual value, my overall net would be a loss of $1, still better than losing $5 compared to a standard call purchase. And the third scenario is if I'm completely wrong in the opposite direction. So in the 3rd month, of course, the share price is well below 65 strike price. My 3-month call sold expires worthless. I keep the premium from day 1. Still have my 6 months, but it's far from being of any value. And I really got to get out as soon as possible. And let's say my option has eroded from $5 to 25 cents. So my profit now is $1.50 from the premium for the call option sold, plus 25 cents for my residual value, minus the $5 I spent on the call purchase for 6 months, and my net loss is $3.25, still less than $5. So to compare everything, the single leg call option was the most expensive, but had the most delta for us to capture most of the gain. And then we introduced you to the bull call spread, where we sold an option at a slightly higher price with the same expiration date to help subsidize the cost of our call option purchased. Then today we introduced you to the horizontal calendar spread, where we have a purchase and a sale of a call option with the same strike price, both at the money, with different expiration dates. And that also helps subsidize the cost of our call option. And finally, just now we showed you the diagonal calendar spread, where we anticipated a moderately bullish trend in the short term, and to protect ourselves, we sold a little bit higher out of the money call. So therefore, we took in less income. And as a result, the net cost is a little bit higher compared to the bull call or the horizontal calendar spread. So as usual, golden rules to follow. Buy into weakness, sell out of the strength. Easier said than done. But always remove your emotions. Preset your expectations of your entry and exit points. Preset your sell orders as soon as you've placed the trade and executed them. And never invest more than 5% of your capital in any one transaction. And again, we're using Canadian equities as examples, but these strategies are used universally around the world in different markets. But Canadian equities have a great diversification from US dollars. There's a safe political climate, stable economy, much better bid-ask spreads for Canadian stocks compared to dual listed on the US exchanges, popular companies that you would have heard of. So let's start today's example. The first one that we have picked for you is a company called Sandstorm Resources on the Toronto Exchange. Their prices have been increasing, MACD is rising, so is RSI, but also the OBV. Very, very strong. So there are institutional support. And when we get a second opinion from Financial, it's exactly as I forecasted. It's a little bit neutral to bearish in the short term, and then bullish. So I think this would be a great candidate for a horizontal spread. So let's get the second opinion again from Options Play. And when I select here in my additional strategies, I want a long call calendar. And here's how it comes out. And it's of the three panels on the left-hand side. So I'm selling a $6 for January, and I'm buying in April. Same strike price. And basically this is a bullish neutral strategy with limited risk of $30 and limited potential of $18. So not that great of a return, but at least it's a good example to show how to execute a horizontal calendar spread. And again, in our simulator, this helps me determine what are my profits if the price hits certain price points higher or lower than my expectations. And you can see on the left-hand side, my net results vary depending on where the stock actually goes. And you'll notice, and you go too extreme either way, you're not going to be making much profit. So if we trade, this is how we do it. Again, I'm buying to open in April further out at the $6. And I'm selling a shorter term, January, also at the $6, suggesting a mid price of 15 cents. So let's go to our trading account. Again, your broker interface will vary, but the concept and methods are the same. So we will enter the SSL and select the one for Toronto market. And of the various expiration dates, I will select April. And for April, I want the $6 strike price. And from my menu here, I want calendar. So I am buying in April and I'm selling in the January. They're both $6, and that's the spreads there, and there is no bid. And somebody is asking 30 cents. So I will ensure that I'm good to close, and I will go and give them the 30 cents that they want. And if I preview the order and submit, that's how I entered a debit spread using a horizontal calendar strategy to buy one for April and sell one for January at the same strike price. Here's a second example we picked for you today, Barrick Gold. And again, Barrick Gold has been rising. MACD is starting to cross again. RSI showing good demand, and again, some nice volume from institutions. In the news feeds, built right into options play helps validate our fundamental analysis. So here we will select then more of a long called diagonal this time. And you notice the strike prices are different. So it's a diagonal play. And here's the simulator. If it goes to certain prices. And we're getting a much better score, a 113 with a check mark. And because it's a spread, I can also vary the dates, and that will impact my return as well. And when I trade it, here's what we do. We're buying to open at $19 for April and selling to open a shorter term January for $20, a little bit high. And that's also suggesting a mid price. So we will go here, select Barrick Gold, Toronto market, and I will select the April. And I just wanted the $19 range. And this time I will select the diagonal. Now, very important, always make sure you select the proper call instead of a put. That's a mistake very easily made. So I'm buying April, selling January, 19 buy, 20 sell. Here's my spreads. Always good to close. And I'm going to be offering just a little bit more than the next person, so 67 cents. I'm not that desperate. And here's how he executes. It's a debit spread, buying one with April at 19 and selling another one, also a call for January at $20. And that's how we enter the diagonal calendar spread. So as usual, here's a long list of the free tools we showed you, and we repeated this in prior videos 8 times already, so I'll give you the short notes version. You can always click on any of these links on your computer, but also remember, get your free account for options play for Canadian equities right at this link at the bottom. And remember, come here at either of these links to get your first month free trial on the options play for US equities. So another great video. Appreciate you taking the time to watch this. Please continue your journey with us. Learn, practice, repeat. Use the virtual accounts that we showed you. Please tell your friends about us. And remember to subscribe to our list on our website for updates and trade ideas. And when you feel you need additional help, try our mentoring services in our marketplace. Welcome back. I hope you enjoyed that video and found it useful. Please remember to rewind, practice, repeat, and if you found it useful, please share it with your friends and family. See you in the next video.